Hello and welcome to the NWF results presentation for the year ended May 2016. Very pleased with the results we're presenting today. They're positive in the sense that they're record earnings per share. We've invested £10 million in the development of the group, both in terms of acquisitions and development capital, which has been pretty much funded through cash that we've generated in our three divisions. And we're therefore recommending an increase in the full year dividend by over 5%, and that very much reflects the confidence that the board has in the long-term delivery of the group's performance. If I turn to the key numbers in the results, you can see the revenue is down a little at £466 million. It's not a concern, that's purely because the commodities in which we're supplying have reduced. That's oil, soya and rape meal. The key numbers for us are operating profit and headline profit before tax. So the headline profit before tax you can see is 8.3 million. That's up 2.5% on prior year. The record is around earnings per share. You can see that's 13.6 pence per share, up 3% on prior year. Net debt is good at 9.9 million. That's less than 1 times EBITDA, and that's in spite of investing £10 million in development capital. As a consequence of that, the board is recommending an increased dividend for the full year. We've actually managed to increase activity in all three businesses. So we've grown our feeds division, increased volumes and increased our market share. In foods, we're at capacity, we've operated efficiently and added repack work to that business. And in fuels, we've generated additional volume and in fact delivered record volumes in the year. Market conditions remain difficult, so for dairy farmers it's tough with low milk prices and commodities over the year fell. Food retailing, where we're distributing and warehousing our customers' products, is a tough marketplace to be in as the supermarkets fight for market share. And in fuels, we had a warm winter and autumn that reduced the market demand for heating oil and therefore made it more competitive. Investment of 10 million included 3 acquisitions, and our strong cash generation managed to offset the natural debt increase that would have resulted. If I then look at each of the businesses and start with feeds, here we've managed to differentiate through focus on nutrition. So tough market for dairy farmers, and therefore our nutritional advisors, our salespeople up and down the country have been helping our farmers to optimise their performance. So if you think of us as a dairy cow as an athlete, we're coaching for improved performance and improved efficiency. And we've been able to do that in supporting our farmers through tough conditions. We've reduced our cost base because we recognise these markets were tough. And the consequence of that is our operating profits have increased on an underlying and a total basis from 1.8 to 2.1 million, and our volumes up at 2.3% to 580,000 tonnes, and that's in spite of the market falling by 4%. If I then look at our food business, we're at full capacity here. The service levels critically have been maintained at 99.7%. The operating efficiency has been particularly gained by leaving full loads on time. And by leaving on time, we've been able to attract a better quality of backload when we're coming back up to the northwest and also attract subcontractors onto our site. In addition, we've ordered new vehicles and we went through a rigorous testing process and selected Mercedes as our new vehicle, and they're giving us about a 1 mile per gallon fuel efficiency whilst meeting the latest Euro 6 standards. You can see in the food business our operating profits are up 8% to 2.7 million, and actually we've stored 97,000 pallets on average right at our capacity level, which is a good performance. In fuels, clearly volatile oil prices, and that doesn't cause us a concern. It actually went to a 13-year low in January 2016 of $28 per barrel. Heating oil is now the most competitive source of heating for your home, and that's helped our business through affordability. We've had good start-up businesses in the southeast, Martlet Fuels down in Brighton, Home County Fuels in the southeast, both of which have outperformed their expectation and in total delivered over 13 million litres between the two depots. We also acquired Staffordshire Fuels, which has been integrated and performing well. Staffordshire Fuels is just over 30 million litres. The net results, operating profit 3.9 million, a little lower than last year, but that's in spite of that warm winter, and good volume growth to a record 474 million litres for the division. If I now look at development and how we're going to move the group forward, what we believe we have at NWF is a very solid platform for development. We've got a diversified source of earnings with our 3 divisions. We generate cash. In the last year, 6 million. In other years, 2 to 3 million of net cash per annum. We've got a development focus on agriculture. In fuels, we can add depots through bolt-on acquisitions or through startups. And in food, we can very much expand that business in line with demand for our customers. And as a total group, we're going to focus on shareholder return. That's the thing we very much focus on as a board in moving the group forward. Again, looking at each of the divisions, in agriculture, you can see the market there in the chart top right shows that we produced a record level of milk in the last 12 months in the UK, 12.4 billion litres, the highest for 10 years. That's actually slipped of late, so milk prices have come down and farmers have reduced production. It's about 10% lower in July and August than it was last year. And interestingly, milk prices, we're starting to get some news that milk prices are increasing. 4 dairies have announced that in the last couple of weeks. Indicatively, that might be better news for dairy farmers going forward. In spite of that tough market, we've made progress. So you can see the volume of NWF now up to 580,000 tonnes and 12.3% market share. Just really charting our progress on this slide, you can see on the left-hand side, 2012, we had 2 feed mills, one in Cheshire and one down in Devon, and customers covering the whole of the UK. Critically, any customers in the north of England or Scotland were delivered from Cheshire by trunking feed up the motorway. What you can see moving forward through the progression is now we have significantly more customers, particularly in the north of England, particularly in places like Northumberland and Cumbria, very much as a result of the Newbreed and Jim Peat acquisitions. And now what we have are feed mills in the north, central and southern parts of England, very much aligned and close to our customers. And we're continuing to invest in those feed mills, both to reduce our cost base and also give us capability for further development. In terms of food, the key is about operating efficiently. What we've been able to do is enhance our capacity here by introducing some lower height pallet spaces, what we call pygmy warehouses. You can see there's very little space between the top of the food and the bottom of the next pallet, whereas on the left-hand side, you can see significantly more space. So it's all about optimization for marginal gains to improve our efficiency and meet our customer needs. And in fuels, as I say, we've continued to expand compared to a few years ago. There are more dots on the map. So we've gone from 13 now up to 19 fuel depots, covering more of the UK. Our volumes in this period have gone from 2012 at 414 million litres to a record at 474 million litres. Again, still doing about 25 million litres per depot. And the volume is very much reflective of a good progression both in our underlying existing business and through the acquisitions. And we're looking to expand this division further. In terms of looking at the investment summary and the strategy for the group, the first thing that we have is strong, experienced, capable managers in each of our businesses who've got experiences of the volatility that we can have in the price of oil, the volatility in weather, or in demand in each of our markets. There are growth opportunities that we have, and critically as a group we have asset backing. That gives us an underpin of security and also enables us to get cost-effective funding going forward. But very much a focus on returns, a focus on generating cash. The net consequence of that, we're able to make good progression with the dividend. So in summary, it's been a very positive year for NWF. We've delivered volume growth in all 3 divisions and have delivered a record earnings for the group. Additionally, we've invested £10 million in acquisitions and further development. In terms of Brexit, there's been no impact on the demand for our markets so far. We've got a good track record of performing in difficult markets, and we're a UK-only business supplying the needs of UK customers. In terms of acquisitions, we're performing in line with expectations and they've been integrated as planned. We've got significant financing headroom for future acquisitions and to support the needs of the group. And after the first 2 months of the year, we're trading in line with the board's expectations for the full year. And the proposed increase in the dividend really highlights the board's confidence in the future of the group. Thank you very much.